Hi everyone. In this video, I'm going to show you how to grow your dividend portfolio really fast in 4 simple steps. As long as you have a decent brokerage app, you should be able to do all of these in like 5 minutes, okay? So sit tight, you're going to learn some really cool tricks. And before you get started, welcome to Buzz Crimson. My name is Shakib. In this channel, I create personal finance content and investing strategies. So if you're into that kind of stuff, don't forget to like my videos and subscribe so you can stay tuned for my future videos. Okay, all right, let's get started. All right, so first step, DRIP. It's very simple, dividend reinvestment plan. You can generally turn on this functionality in your trading app. What it'll do is when you get paid dividends, your trading app will reinvest that dividend into the same stock. So when you get paid dividend next time, you're going to get more because you own more shares. It's that simple. A lot of people don't really see the impact of this or don't think about it much, but let me show you how powerful DRIP can be over time. So here's a stock that's $21. You own 100 of them with 7% yield. In your first quarter, your dividend income will be $36.75. That money will be reinvested because it's your DRIP functionality's on. It's going to buy you 1.75 shares. Next time you're gonna get $37.39, a little higher than last quarter. And now you're gonna buy 1.78 shares. It goes on and on. We're looking at a 3-year time period. At the end of 3 years, you're gonna own additional 21 shares. And your dividend amount from Q1 to Q12, you're looking at about $8 increase. So as you can see, it can continue piling up. It's an exponential situation, so very powerful. All right, let's go to next one. Long-term and priority growth. Don't get fooled by really high yields. I know if you're new into dividend investing and you go to a lot of the screeners and you filter by dividend yield, you're going to see a lot of random weird companies that show up at the top. Your familiar companies that are like Microsoft, Microsoft, AbbVie, AT&T, these are not going to show up at the top because those are long-term type of investments, as opposed to the companies that you're going to see at the top that got like 10%, 15%, maybe 20% yield. These are BDCs or essentially very risky stocks, closed-end funds. They give you really high yield because they're very risky, and they generally have very high payout ratio. They tend to pay monthly, but the reason why I'm bringing this up is because a lot of new investors, they think that, well, I don't have all this time for long-term growth. I just want as much yield as possible now. Well, there's no guarantee. If you look in the history of those companies, they tend to have poor track record in terms of paying out dividends. Especially if you look into BDCs in 2020, you'll see that most of them took dividend cuts. A lot of them stopped paying dividends. So it's important that you think about long term. And in the long run, the companies that they have a very good track record of paying dividends, they will give you a better return over time in terms of the stock appreciation and dividend growth. Key example, Coca-Cola. It's a dividend aristocrat. Over 50 years of growth. You can't go wrong. You can invest in Coca-Cola the same amount, and then you invest the same amount in any other BDC. Over time, the Coca-Cola with half or maybe 1/4 of the yield of the BDC is going to outperform, because Coca-Cola will never cut its dividend based on the track record, but BDC, high chance that it might, because that's the way it is. Okay? All right? I do have an example to show you very quickly. I invest $5,000 and I look at their recent financials to simulate what would happen with that $5,000 over 10 years. Here's Microsoft. $5,000 would turn into about $148,000. Insane return. AbbVie, same situation. $5,000 turned into $35,000. Very good return, right? And then you look into a BDC, Ares Capital, almost twice as much yield as compared to AbbVie, or 8 times compared to Microsoft. but that $5,000 in heirs capital is only going to become $16,000 based on their financials, because they're just not that high quality investment compared to Microsoft or FE. Okay, simple. All right, moving to when to buy. Dollar cost average. You should dollar cost average, and you should think about ex-dividend dates. Let me explain what I mean by that. If your average cost on the stock is $25 and the stock is trading at $22, you can continue buying to read dollar cost average. Okay, but if that's not the case, then you need to, and you have funds to invest, then you should think about ex-dividend dates, because generally on ex-dividend and after, the stock goes down by the amount of dividend, and it's just that simple. You are high likely you can probably buy the stock at a relatively lower price compared to the days before ex-dividend date. It's just the way it works. It doesn't always work out, but personally, in my experience, it always helped me to look around, to shop after ex-dividend date or on ex-dividend dates. It's crucial that you think about your cost. The lower you can keep your average cost, the better it is for you. So always prioritize that. Lastly, this is probably the most powerful tool here. I mean, I'm going to say DRIP, and this is probably the most powerful one. Write covered calls. Make your money work harder than it is already. Okay, let me show you an example. Right here, EPD, one of my favorite dividend stock. The stock is trading at $23.45. Let's say I buy 100 shares today for my dividend portfolio. It's got about 7.7 yield. So in 1 year, it's going to give me $180.57. However, so based on EPD's recent ex-dividend dates, I know that the next one is going to be somewhere around April, late April. So I have a couple of weeks. So there are 4 ex-dividend dates each year, right? 4 quarters. So generally you can sell probably 3 calls, covered calls between each ex-dividend dates. So 3 times 4, 12. You can do this, right? Covered calls 12 times in 1 year for each 100 shares against each stock where you own 100 shares. Okay, so let's go to EPD. When I go into 3 weeks ahead and I'm comfortable about $25.50, such as it's relatively out of the money, this will not be assigned. If I sell a covered call here, I can get $13. So I'm pretty sure I will be able to get similar type of premium throughout the year if I pick out of the money strike prices. So let's look into this. So $13 times, I can do this 12 times in 1 year, $156 premium. Okay, so overall, from that 100 shares, I'm able to generate 14.35% return, and I still own the shares. So these shares are going to continue making a similar amount next year, which essentially, which is essentially twice as much of what I would get if I didn't do anything and just waited for my dividend, right? So very powerful tool, relatively risk-free. Worst case scenario, you get assigned, you get to sell, you have to sell your shares, but you make money from stock price appreciation, right? So, and then you can just buy the shares again with the proceeds. So rinse and repeat, very simple, easy to do, barely any risk. So that is it for this video. If you have any questions, let me know in the comment section. And if you like the video, don't forget to smash the like button and subscribe so you can stay tuned. Okay, all right, thank you for watching.